In many projects, the investor does not have all of the capital available to make an investment and must borrow funds to satisfy the project capital needs. This is often true when national companies participate in the ownership of a project, such as the large Qatar LNG projects, or for regulated projects, such as the regulated underground storage facilities that I built in the United States. In that case, the Federal Energy Regulatory Commission required that we obtain debt financing to reduce the service cost to the end users. Because some projects, perhaps one or more of your projects, are often built with debt financing, let's see what the impact would be on the project metrics of our case study if we were to borrow some of the required investment capital. A project that relies on debt financing is usually referred to as a leveraged project. Now let's consider again the investment cash flow for our case study. During the first 3 exploration years, the company must assume the exploratory risk by making 100% equity investment. These are shown in green. However, once reserves have been found, and we can demonstrate the creditworthiness of the project, we should be able to borrow funds from lending institutions. We will assume that the level of borrowing, shown here in orange, will be 50% of our total capital requirements, and that the interest accruing during construction, shown in red, will be capitalized and added to our investment cost because there's no income yet from production to pay the interest charges. We also assume that we will repay the loan at a fixed annual amount over a 15-year period. Note that the equity investment, shown in green and blue, is equal to the sum of the debt, shown in orange and red. Now we add the projected revenue stream for the project from years 6 to 20. As we did earlier, we now need to convert the revenue stream to annual cash flow streams by subtracting the annual cash payments. Beginning at the bottom, the cash outflow payments include royalty payments in purple, operating costs in yellow, interest payments on the outstanding debt in blue, and income tax in pink. We remember that the depreciation charge, shown in maroon, is a deduction for tax purposes, but not a cash expenditure. The income cash flow each year, then, is the net income after tax in gray, plus the depreciation in maroon. To obtain the cash flow for the project, we must subtract any additional capital investment made during the year, shown in red, and subtract the principal payment on the loan, shown in orange. Since no new capital investment is assumed needed during the production year, the red entry is essentially 0. The income cash flow for the year, then, is the sum of the 3 entries, gray, maroon, and orange, which is shown in the right-hand column. We make these calculations for each of the production years and end up with the income cash flow, shown here from years 6 to 20. During this period, we essentially pay the annual interest on the loan, pay back the debt, and receive the project income cash flow on an after-tax basis. As we did earlier, we can now accumulate annual cash flows, but include only the equity investment, those in green and blue, not the debt portion, because equity is what the shareholders are investing. Here, then, is the cumulative cash flow from and to the shareholders. Notice that our equity investment, rather than being $1.4 billion, is $733 million. It's a little bit more than half because $33 million reflects the capitalized interest during construction. We see that payout occurs in about 7.5 years, and we have a cumulative cash flow of $3.482 billion. So the total profit is a little bit less than we had before, but the investment is much lower. So a lot of good things have happened to our projection. We should get payout sooner, we make a lower capital investment, and we get what looks like a better performing project. The next step is to discount the cash flow stream at our cost of capital, 10%, to find its present value. We see that the discounted investment is $511 million, much less than for the 100% equity case. The payout on a discounted basis occurs at about 8.5 years, and our present value for this project is $888 million, significantly higher than we obtained for the unleveraged case. So we see that our equity investment is considerably lower, and the present value of our cash flow is significantly higher. Let's see what happens to the IRR. Using the chart approach, we calculate the present value at different discount rates as shown here. 3.482 billion at 0 discount, 888 million at 10% discount, and find that the present value approaches 0 at a discount rate of 29%. This then is the IRR for the project when we use 50% debt. It is significantly higher than the 21% we obtained for the 100% equity case. But please be aware that we're projecting an IRR of 29% on an equity investment of $733 million here, while the other projection reflects a projected IRR of 21%, a $1.4 billion investment. If you have lots of capital to invest, as for example the major oil companies, you would likely prefer the 100% equity opportunity. But if capital is constrained, or the regulator wants you to keep your tariffs low, you would probably pursue the leverage case. We should point out that we could very easily have used the Excel functions to calculate the present value in IRR for this case using the annual cash flow projection shown in the previous slide. Why don't you try it? The reason that our IRR is higher for the leverage project is that our weighted average cost of capital is lower. If we use only equity, our cost of capital is 10%. However, if we borrow 1/2 of the capital at an interest rate of, say, 6%, and the government allows us to deduct interest payments for tax purposes, then our average tax cost of debt is lower. Specifically, if the tax rate is 40%, then the effective cost of debt is 3.6%. Now if we have a 50% equity and 50% debt capital structure, then our weighted average cost of capital after tax deduction of interest is 6.8%, which is significantly lower than the 10% cost of capital for the full equity case. Now we can prepare our spider diagram using the base case we just presented with an IRR of 29%. When we consider the risk sensitivity of each variable independently, we see again that the two major sensitivity variables are the capital investment costs and the revenue stream. If you expect the range of uncertainty to be within 20% of the base case values, that is, if the range of capital investment may range from 20% less to 20% more than the base case costs, we can see that the internal rate of return will range from a high of 36% and a low of 23%. On the revenue side, if the revenue is 80% of what we were projecting, the internal rate of return will drop to 22%. And if the revenue is 20% higher than the base case, we'll be up to about 35% internal rate of return. So we potentially have a very robust project. Again, we see that the tax rate, the interest rate, and the operating cost variables are not quite as steep as the revenue and capex, which means that the project is less sensitive to these variables. So the range of uncertainty in the IRR is between about 22% on the low side and 36% on the high side. Still a very promising leveraged project. Now we can summarize the project metrics and compare from both a leveraged and an unleveraged perspective. we see that the cumulative cash flows are quite close, but that the 100% equity case delivers about $400 million more cash than the leverage case. Total capital investment for the leverage case, $1.466 million, is $66 million greater than the 100% equity case because of the cost of interest during construction. The equity investment for the leverage case is a little over 1/2 of the $1.4 billion that is needed for the 100% equity case. For every dollar invested in the project, we estimate that we receive $2.7 for the 100% equity case and $5.7 for the leverage case. So in the latter case, we get more cash flow for every equity dollar invested. The present value, discounted at 10%, is higher for the leverage case, $883 million, as opposed to $783 million for the unleveraged case. The internal rate of return is 21% on the 100% equity case, but 29% for the 50% equity case. Remember, though, that the higher return is being achieved on a smaller amount of equity. If we have an inventory of projects, lots of projects, that each will return 29%, you will likely use leverage for all of them. Otherwise, if your capital availability is high and your portfolio of projects is low, you will likely put more equity into the projects, because an IRR of 21% on equity is a very appealing outcome. Finally, from our spider diagrams, we learned that the range of uncertainty in the IRR for these two project options is 16 to 26% for the 100% equity case and 22 to 36% for the leverage case. This project should make sense even at the lower ends of these ranges. So when you consider an investment in the future, you now know what metrics are generally calculated to analyze the project and how to calculate them. Your company likely has its own way of preparing the analysis and which metrics it prefers. However, the fundamentals should all have been covered in this presentation. Be sure to test your understanding of this session by completing the exercises. Thanks for watching, and good luck.